What's going to happen with rates in 2024 in the real estate market? Well, we're going to find out next. All right, everybody. Hey, let's get into the forecast for 2024. This is done by MBS Highway. You might have heard of Barry Habib, and we're gonna cruise on through it. I just want to get to some important things on where rates are going, so you make a semi-educated decision on what is going on. So let's look here. The big thing, you hear all the time is core inflation, and they want to get core inflation. The Fed does down to 2%. Well, is that going to happen? I don't know. But that is their target. So their target's 2%, and right now we're sitting about 4%. So what does that mean? The biggest component of this core inflation is obviously shelter. That's the most expensive thing out there. Let's be honest. That's it. So what you will look here, you'll see like here in 2021, COVID, it really jacked up. Rents went through the roof. Just through the roof, which is just crazy. And now they're sitting at about 2.5%. Not 2%, but 2.5%. Last time it was below 2% was back in June 2020. Now, this is a major move down, and these numbers are replaced on a yearly basis. So let's look at here. It's the other line, shelter year-over-year change, and you can see these year-over-year changes with this gold here. And we're still lagging here. This will continue to go down here, but this is what they're looking at right now. 6.5% on the CPI, when the true month over month right now is 2.5%. So because this is still looking back a year later. So let's see what happens. And so you can see this lag effect here. So there's core CPI, there's a lag effect of 1.8%. So we're really sitting here at about a CPI right now of 2.2%. We're getting really close to 2. They are seeing this, and that's why you're hearing about rate cuts, etc. So let's see what else happens here. And now you got your shelter and CPI. It's showing the year over year and where we're sitting at. Obviously, we had that spike up in parts of 2023, and now it's definitely coming down. So what's going to replace in December? We are very high. So you're at 0.79% in December. So we're replacing this from 2022 at 0.79%. And the thing is, we're going to replace that with a much lower amount. And so that should bring the CPI down. And that's what we're really counting on. So in January, we're same thing. We're replacing 0.74. We're replacing 0.76. And this should be a really good time for the CPI to be dropping because shelter is dropping, which accounts for about a large portion of the CPI. And then after that, it gets a little bit trickier because it's not as drastic of a difference year over year. But what are the expectations for inflation and the Fed cut? Well, Fed target is 2%, and we're currently at 3.16. So let's see what will happen next. So December, 0.1% monthly estimates. And these are just estimates, and they're probably right on. What's going to be replaced with 0.39 in December. And then your core PCE year over year will be about 2.87. Still not at the 2%. So I don't think anything's going to happen in the Fed meeting in January 31st as far as lowering the interest rates. Now it gets interesting when we get to March. You see this PCE, you see it drop. Well, look, there's a magic 2% right there in March and April. So you think they would have to probably start cutting before then, and that's what a lot of people are thinking. Well, what are they thinking? So here's what they're thinking. The market's odds on the Fed cut. I don't know. This is like gambling in a sense, but with numbers to back it up. So they're backing it up with something. So in this case, January, just like I said, 7%. Yeah, it's not going to happen in January. March, there's almost a 70% chance that we're going to have a drop. I would probably agree with that. It'd probably be the first time they would do it. So 56% chance of a 50 basis points drop in May. 91% chance of a 50% in June. So someone's even saying 75. So it'd be very interesting. So they think they're going to have drops at least So, they're talking about 6 times next year. I don't know if it's going to be 6 times. 6 times at a quarter point each. That would be, 150 basis points total off the Fed rate. Well, I think that's possible. So this Fed dot plot, now we're getting pretty stinking technical. All these little dots represent Fed members. And it represents, you'll see here, like here in 2024, let's look down this line. 2 of them think 0 cuts. 1 of them thinks 25. You get the idea. 1, 2, 3, 4, 5 think 50 basis points. And there's a high probability more people think there's going to be 75. And there's 100. And a little lone guy down here says 150. Well, he'd win the jackpot because the odds are pretty much against him that we're going to get a 150 basis point cut in the year 2024. But it could happen. Very well could happen. And that being said, you look over here. Going farther out, the Fed members see even lower Fed rate. That's your overnight rate. That's what you guys are affecting your car loans and all that kind of stuff. It affects everything. Look at, it starts out here at 5.5, which where they currently are at, and look where it's coming down to. You got, 3.5 over here, and then 2026 and longer out, you see a rate below 3 to down to, in the 2.5, 2% range on your federal funds rate. Fantastic. Very, very interesting to see. So we see a nice downward trend here, and that's what we want to see. Look at that trend. We'll follow that arrow. It's a downward trend. So everybody be happy. We survived 2023. We're moving forward. You made it. Let's ride this thing down a little bit, and it should. Now we get in the Fed balance sheet, outright holdings. This is how much they hold in basically money, and $8.5 trillion at the top, and then they really started selling off treasuries and mortgage-backed securities, and they sold off a nice chunk. But I don't think it was enough to get to their goal. And you'll see the numbers here, and we'll show you some more numbers that'll show you what's going on here. So here's a balance sheet breakdown. And this is in millions, guys. So this is 4.25 trillion. And so just to give you an example, it's not just, that's where it's sitting at. So this was, and then pre-COVID, we were sitting here. I think the number to really look at is this balance sheet versus GDP. That's the number that really makes a lot of sense. Back here, we were at 22.4% of GDP, and then pre-COVID, we were even better. We were at 21.3% of GDP. And GDP's been going up, and that's good, but see what else went up. It went to 33.2% in April of 2022, and almost doubled in the amount. We went over 8.4 trillion from 4.3 trillion back in 2020. So in 2 years, we almost doubled. And so that's what's causing this problem here. They do not want to see 33.2%. They want to see it back here in the 20% mark. So the Fed's not really happy with that. So they're probably going to continue to sell mortgage-backed securities and the bonds here. Now, January 2024, we're still at 25.6%. So we've came off the 33.2% at 25.6, but still not back to where we were. I'm going to call it pre-COVID, since everybody else does. But look at the projection going down. And these numbers, they're pretty solid. They're pretty conservative projections on what is going on. So you see the GDP balance sheet over here. That we're probably not going to see anything till, let's say, June 2024. And then there's going to be some easing of them selling so much in regards to mortgage-backed securities and treasury bills. And what that does is that loosens things up and should help with driving long-term interest rates down. So that's a projection. In a nutshell, long-term interest rates should be coming down. And that's great. So let's go on. Excuse me. So now what we're going to see is that's when they're talking about between June. And you got to love this one. So this is Mortgage rates, they decline during a recession. Every single time. Look here, 1975, 1980, 1995, 1990. You gotta love basically 2000, and you gotta love 2008. That was a lovely one. And we had that mini recession back in 2020. We're gonna have a recession, and interest rates normally decline during a recession, bar none. Every single time. Every single time. You can almost take that to the bank. And so that's another factor that should show that rates are going to be dropping. So 2024 rate forecast, not rocket science here. 30-year fixed rates are going to be somewhere between the mid 5% and 6%. So that's where I think they're going to settle. I don't think you're going to see the fours. It's going to be longer out before that happens, unless something drastic happens. So under 6%, though, that's going to start unlocking the move-up buyers, and the move-up buyers are going to come in and start and want to buy. So that's going to increase some demand. 10-year Treasury somewhere between 3 and 4.4%. I am totally in agreement with that. And this should return to more normal spreads that could cause mortgage rates to drop further, and that's what we were just talking about in the prior slide. And I feel that'll happen. And so, let me see what we're doing here. Real estate forecast. So inventory remains tight. I mean, golly, we all know that. Inventory is definitely tight. But it should loosen up as we bring in the move-up buyers that need to sell their houses, etc., and the move-out. I mean, there's a large portion of the population that I think has been holding on to houses and holding off their plans to move out or into a different part of their life and get those houses on the market. And so that is the key. So inventory still remains tight. It wasn't as tight as it was in 2022, but it's in 2023 was tight. We'll see how 2024 goes, but it'll be interesting to see. We're just not building enough. This blue here is basically telling you here's a demand of people that are going to want homes, right? And here's the completions. We're just outpacing the completion of homes being built. So we need to just keep building and building and get this thing squared away and have more houses open up on the market. So here's a big fallacy. I really like this. Affordability, not as bad as the media claims, because the media is they're skewing the numbers, guys. I mean, we're all about the numbers. You look at 2021, and they're right. 2021, $240,000 loan at 2.875%. Your principal and interest is about $1,000, right? Monthly income back then was probably around $4,000. So what the media is telling you is basically, okay, now not only did houses go up, so now you're taking out a $280,000 loan instead of $240,000. But your interest rate's like 6.625, and your payment just went up $800. And then the media wants to say, wow, that's an 80% increase. But the problem is they don't take into consideration that it's really based on monthly. It's a 20% increase because income has gone up. Income has risen 15% since 2021, according to ADP. Okay. And so it's at 15%. Well, it's a lagging effect. And people that I've talked to and mentioned this before, the bad thing about interest rates going up at the same time that the mortgage rates go up, the lagging effect is always income. And so the affordability, you feel it until the income catches up with all this inflation that we're dealing with. Now, there's some exciting things that are going to happen, and you're already probably figuring this out. And we'll get to that. The real estate forecast right now, national appreciation, in some areas it's going to be lower than this 4.5% to 5%. It's, but the reality is we're going to hold on to our values, and they're going to go up, and that's fantastic. The kicker here is, transaction volume. So 15 to 20% more than last year. I think it's because people are going to loosen up a little bit. Rates are going to come down a little bit. They're getting used to, what's happening. Their incomes have gone up now too, and they can swallow that. And people want to own homes. It's wealth building, guys. It's the biggest wealth building thing out there. which is very important. So the demand is there, and it's just they're going to buy. Hey guys, I hope that all gives you a grasp of what's going to happen in 2024. Obviously, we're going to follow through this together on a weekly basis and see what really is going on. We're going to have some turmoil. We're going to have some up and downs in the rates, but the trend is that rates are going to continue to go down, which is a good thing for everybody. It's a good thing for the economy. It's a good thing for people that want to buy homes, etc. So the other thing I didn't really mention that you need to understand is as these rates go down, more buyers are going to get in the market. That was the 15 to 20% increase. And more people are going to decide, hey, rates have come down, so maybe I can move up or move down. That's going to bring more inventory. That should level things out also. Hey, hope you have a fantastic day. You like this channel, go ahead and like it, subscribe, and have a fantastic day.